Hey, my name is Ilya Kobe with Kobe Real Estate team at William Raveis. And today's April 23rd, 2020, and we are almost 5 weeks into this unprecedented times that we are living in. And just I wanted this week, I just doing this interview with Bob Flynn, who is our mortgage loan officer from William Raveis Mortgage Department. And we're going to go over some of the changes that have has happened during this time. And we'll bring you some valuable information. So from a real source and from a veteran in this industry. Um, Me and Bob have been working for years now, and we have served hundreds of clients. But I'm just gonna let Bob tell us about his business profession and something about himself.
Oh, thank you, Ilya. Thank you for that great introduction. It's been wonderful for working with you over all this time also. Personally, I have over 30 years experience in the business. I ran my own mortgage lending shop for over 23 years and have been with Raveis as one of their top loan officers for the last 6 years. Always top 1% of loan officers in the entire United States. So that's a big plus. And not too much that shocks me nowadays or that I haven't seen in the past having that much experience. My NMLS number is 6314. Besides being such a low number, it shows how long I've been in the industry as well as how old I am. Turning 60 this year, so it's a big birthday in December. Yes, so changes this year, unprecedented. You know, I've been through two complete financial meltdowns, this being the third one in my career. And the first one being in the 90s when we had the RISLIC debacle, which was the savings and loans and all those smaller banks being shut down. And then, of course, 2008 with the financial meltdown in the housing market. And now this, being unprecedented. The difference now is it's not housing related yet. And we're hoping that we don't see values lower because of the amount of people that are now struggling to stay employed. Big concern for us moving forward.
Yeah, I've seen. Everybody goes through changes, and our life has changed a lot. Like being inside our houses, and many people are working from homes, and kids are out of school. So, this it's true that this situation has affected pretty much everyone. And a lot of people are reaching out to me every day asking about the real estate. Most of the number one question is that if real estate is going to come down or if price is going to come down. And as you mentioned before, people are remembering what happened 2008, 2009, and I also been going through that recession that happened on 2008, 2009. But personally, I haven't seen like big changes in as far as real estate in general about prices. But I have seen, the most changes I've seen in the mortgage industry, like compared to 3 months ago. And we see changes happening every day. Can you please go over some of these changes?
Absolutely. So there's a couple reasons that we've seen the changes in the mortgage market. Technically with the Fed fund rate being as low as it is, and that's the Fed fund rate is what they lend to banks, and then banks control prime. The mortgage market is controlled by the secondary market, bond investors. And we've seen a lack of appetite right now because of the liquidity issues and also because of the capacity in the system. When the rates dropped initially we saw a rush on refinances, which is great. It helps consumers and it helps the economy because people will have more money to spend by having more monthly liquid cash flow by having lower payments. Once the capacity filled up, the investment portfolios they weren't as attractive. And then with liquidity issues, and what I mean by that is the servicers are not all banks right now. So in the secondary market, if you're not a bank entity, you don't have the ability to borrow money from the federal government at that 0.50 interest rate, the Fed fund rate. So you're having to use your own funds to support yourself. So when they talk about the high unemployment rate, which has been increasing weekly, and we're talking about 25 million by the end of next week, we have a lot of people that are going to be requesting to be furloughed. And what that means is that they can work with their servicers to either defer payments, tacking them on to the end of their term, or having to have a lump payment due at the end of their 4-month furlough. The problem with that for these servicers they are not off the hook. So the federal government is directing Fannie Mae loans or Freddie Mac loans, because they're both in receivership of the federal government, to allow these consumers to not have to make their payments. Now, unfortunately, with these servicers, they're still required to make payments to the secondary market, to the bond investors. So if they're not able to borrow money at a low rate, they're basically on the hook for billions of dollars that they may not have. So it's going to put them in a difficult position. So liquidity gets tightened up because they don't want to make more loans and have more on their books that will affect them negatively. We're looking at about 5 to 8% right now of loans being requested to be furloughed. And that's a big portion of their portfolio. And it's going to put them in a very difficult position. So just recently this week, they finally put their heads together and decided that they were going to help some of these secondary market servicers that do not have the ability to obtain liquidity. And, that's going to help them. But what they're doing is telling them that they will have the ability after 4 months of furlough to then furlough themselves from paying the secondary market. So it's still up in the air, but until we work through the liquidity issues, we're going to have an extremely tightening mortgage market. And there are going to be repercussions as far as what they're willing to lend. The loan to values are going to be tightened up. The credit scores are going to be tightened up. And they're going to funnel down to really just the best of the best to be able to get these loans. So unfortunately, we're feeling it now.
Bob, thank you for touching base on this deferring these payments. And I have some of my clients have reached out to me because they read a lot of stuff. I mean, there's a lot of stuff, and we know that sometimes that information is misinformation.
Absolutely.
Is that a good idea for someone who has the ability to pay, but he, based on the fact that the bank will not charge him fees or late payment, and he decides not to make that payment? Or what impact would have that thing to someone who does that? Or
Great
I'm
question.
talking for someone that is going through hardship, I understand that, but some other people think that, because the bank are not requesting us to pay, or they're not going to foreclosure on our property, maybe I can skip a couple of payments.
Right. That's a great question, Ilya. So forbearance does not mean forgiveness.
Yeah.
The program is for the people, and you mentioned it, it's hardship. If you are not able to make your payment, you have no choice, and they're going to help you, hence the forbearance. It's important to understand that each of these servicers have their own rules and regulations. Now, you're able to call them and request it, and they're not supposed to ask for official documentation to prove that you're in a hardship, but you are at the mercy of each servicer's internal rules and regulations. They're not all the same. So you need to be careful and just don't assume that it'll be done automatically. Some of the servicers that are not bank entities are going to require maybe that you lump sum it at the end of 3 months. And no one wants to be in position to write a large check of 4 months mortgage payments because they were in forbearance for that period of time. So it's important to understand your options with these individual servicers. The other thing is you want to make sure you get everything in writing. You don't want to find out in 4 months that there was a misunderstanding and that they're marking you down as a 90-day mortgage late, because mortgage lates are a no-no, almost as bad as being foreclosed on or doing a short sale. It's a third worst thing that you can have on your credit report. So just cover yourself, cross your T's, dot your I's. Some of the servicers are tacking it on to the end of the term. Some of them requiring a bulk payment. Just make sure that you know what you're allowed to do. My suggestion is if you can make your payments, make your payments.
Yeah.
You know, if you're still working and you have your income or you have your reserves, that's what they were there for. And we will get over this. This will end. Science will win on this, and we'll be back to normal before you know it.
If somebody does that, like, is that gonna impact their credit? Like,
it's not supposed to. The official rule or word is that if you are granted a forbearance, they're not allowed to affect your credit or mark you as a negative on your credit report, nor are they allowed to start a foreclosure proceeding. But again, it is up to your individual servicer on what they are going to allow. So you need to contact them directly and making sure that you are both on the same page and follow what they instruct you to do.
Great. If you can give some advice to the buyers out there, or somebody who is like in the process of buying, or he wants to buy something pretty soon in the near future, what's some of the advices you would give for them during this time,
Great question. So a lot of our conventional loan programs, which, and I mean by conventional, it's sellable to Fannie Mae and Freddie Mac, and they're in receivership from the federal government. They allow us to do a home purchase with 3% down still. That hasn't changed. Now, the level bathtub or the max loan amount in the United States is $510,400. Here in Massachusetts, in some of the communities that you work in, we have a high balance. Now, those high balance are a hybrid jumbo, but still sellable to Fannie Mae and Freddie Mac, and they allow us to go up for a single family to $690,000. The problem is that the liquidity issue has caused those rates to skyrocket. So if we have an average rate of 3.25% for a 30-year fixed, those high balances are 4% or higher right now, so not as attractive. In regards to the single families and 3% down, we have some really great first-time buyer programs, although technically you don't need to be a first-time buyer, you just can't own other property. Home Ready, Home Possible, it gives you a discounted PMI. There's no reason for a client to wait to save money only to find out values are 3 to 5% higher in 6 months. They save 10 grand, but things cost $40,000 more. And/or rates move higher, right? Rates move up to 4% again, which we were before this started. You're losing $50,000 to $80,000 in buying power to save 10. It makes no sense. People should not be afraid of PMI. If you have PMI now at 3.25%, well, that's much cheaper than having no PMI at 4%. So it's about getting pre-approved and making sure that you know what you can afford, and asking questions. We can help them with that.
Thank you, Bob. Can you please? I know about what's some changes in the appraisal based on the fact that for safety issues they cannot go in the property, and just to keep also the consumers to be safe and the safety of the appraiser at the same time. Can you touch base on that appraisal or drive-by appraisal?
Absolutely. So the majority of my refinance customers now are getting something called a PIW, and it's an appraisal waiver.
Yeah.
Purchases, we're seeing them, if they're putting 20% or more down, they're more likely to get an appraisal waiver. Fannie and Freddie have been using computer models for years now to track property. So sometimes these properties are resold 2 or 3 times, or the neighborhood that they're comfortable with the value. So if the value in the computer model grants them the ability to see the value there, they're not going to require an appraisal. Saves our clients $500, saves us time and aggravation, and allows us to move quicker through the process. If appraisal is required, we're seeing either a desktop or a drive-by. So the appraiser is not required to actually go into the property. They're using the multiple listing service photos in order to complete their sketches and their appraisals, and everyone's staying safe in regards to that. Portfolio loans, jumbo loans, anything that's not sellable to Fannie and Freddie, it's not a conventional loan, have their own internal rules and regulations. Most of them are following Fannie and Freddie guidelines and allowing drive-bys or desktop, unless you're doing a cash out on a jumbo or if it's over 80%. Normally we don't allow portfolio loans over 80%, but we do still have some jumbo lenders doing it. If that's the case, then they're going to ask for a full appraisal. So we have to make arrangements to make sure the home's cleared and everyone's being safe with it.
Thank you, Bob.
You're welcome.
Yeah, you cover much. You cover a lot of topics today, and as always. And I know that this industry is so broad, so we can sit here for hours and hours to talk about mortgages and guidelines. But
things are changing, Ilya. Actually, I just was notified an hour before our call that some of the largest lenders in the United States, servicing lenders, because they still sell to Fannie and Freddie, but they service loans, Chase and Wells are completely stopped jumbo lending, and they will no longer allow a cash out refinance even for conventional loans. So things are going to change and tighten before we get better. So stay tuned. I'll, of course, keep you always apprised of any changes as they occur.
Yeah. Last, I just wanted to, because I've seen the benefit of many of our clients, and that we have worked together of having a mortgage department in-house, like William Raveis Mortgage. And we're seeing things happening very fast. They're happening faster than they're going to another lender. And can you tell us something about our process and why?
That's a great question.
And what I mean, I know, but just tell them to our clients and consumers out there for a great job you guys doing at William Raveis Mortgage.
Yeah, it's a slogan that I use now. It's business as unusual, right? So as you know that, we can literally do a closing, within 30 days and sometimes shorter.
Even in especially, right?
Yes, especially with the appraisal waivers, if we are granted them. The appraisal is the time consumption of any transaction. Bigger banks, that's a different story, but for us it is. So we have our operations people that are actually working 7 days a week, 10 hours a day. We have managers and senior managers actually working and pushing documents around. So our clients, you are our client. We always want to make sure that our clients are meeting their contract dates and deadlines. So it's important to have a great system, which we do. Our technology is top notch. We use the same encryption that the Pentagon uses for our files to keep our clients' data secure. We use a non-paperless system, so everything's done through the computers and online. And even our attorneys will use drive-by closings to keep our clients safe. So, you know, we are still doing our closings in 30 days and protecting our clients always with their contracts, to making sure that they can get started and finished safely, securely, and on time.
Thank you, Bob, and thank you for this interview. I appreciate it so much for being with us today and sharing all this information for all the our clients out there, our sphere of influence, our consumers that are going to be watching this interview. And if someone want to get in touch with you, what will be the best way to reach out to you?
Great question. Thank you. So my email is very simple. As you know, it's bob.flynn@raveis.com. RAV as in Victor, EIS as in Sam. And my cell phone number is 508-944-8218. Call, email, text, and I'll be available.
Thanks, Bob. Hopefully, we're going to do another one of this because, as you're saying, things are changing day by day and hour by hour. However, thank you and be safe.
Thank you, Ilya.